So good afternoon, ladies and gentlemen. Thank you for taking the time out of your busy schedules to join our webinar today as we discuss the investments for expats in Italy. Feel free to have a look at our YouTube channel for other events we've done in the past. The last time we spoke about Italy, we talked a bit about taxes and such. So have a look on our YouTube channel. We'll make sure you get a link to that after the event. But make sure you look at that, subscribe, like, all that good stuff. That'll be much appreciated. Today's presentation will begin shortly, so we will be putting everyone on mute when the presentation begins if we haven't already, so please feel free to ask any questions in the chat and we'll do our best to answer them. And before we start, a few disclaimers to go through for compliance, so just bear with me. The information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. So be sure to first consult with a qualified financial advisor and/or tax professional before implementing any strategy discussed herein. So today, Brian and I are going to, like I said, go through a bit about investing for expats with regards to Italy. And as you can see, my colleague Brian has shared his screen. So we'll just go through a bit of background on investing for expats. So Brian, let's just go from there. So how do we want to set the stage here?
I think that the first and most important disclaimer that we want to say is let's make this an interactive session. If you have questions, please toss them in the chat. We can unmute you. We'd love to interact with you and make this as good as possible. I've got the whole classroom ready, so when you guys are ready for an in-person event, we're ready to have you. I'm based in London. Josh is joining us in, what time is it over there? It's not.
It is 7:30 in the morning. So
nice and early. We interrupted his vacation in California, but he's normally in Italy. So he's your local resource there. Our firm, Dunhill Financial, concentrates only on American expats that are abroad. We have our European, UK, and US licenses, so we can help in all those different types of situations. And that's to where we want to concentrate today, on what to do when we are investing as an American abroad. Three things that we really want to take away from today. First and most important thing, what not to do. You don't have to work with us, but please don't come to us a couple years from now with some of the different nightmares that can cause 10 times more headaches to unravel and to fix. Number two, how to start your plan. It can be done fully with a financial plan or such, but essentially, where do we start? What's step one? And three, aligning your investments with your morals, i.e. ESG or socially responsible investing.
John Burrow once said, "A man can fail many times, but he isn't a failure until he begins to blame somebody else." Despite these wise words, we are in the age of Trump and Brexit. Therefore, let's start to point fingers. Most all American expats have had many negative ramifications from the Foreign Account Tax Compliance Act, also known as Fatca. In fact, it might have led to the closing of your brokerage account in the United States, or even your non-US bank telling you to go elsewhere. So it's Obama's fault, right? Not exactly. When you follow along with Fatca brought about, it's really introduced ways that American expats could get caught while not declaring taxes, owning PFICs, or even not declaring taxes that were owed. So if Obama just built a means to catch non-compliant individuals, why did everything change for expats in 2010? Well, rules from past presidents started to be enforced. Ronald Reagan, the beloved president that was in favor of cutting taxes, added a huge tax to American expats with foreign investments with the introduction of PFIC rules, also known as passive foreign investment companies. These were designed to prevent Americans from owning managed vehicles from foreign jurisdictions. So what about the notorious Nixon?
In 1970, Richard Nixon signed into place the Bank Secrecy Act, and American expats had to report all foreign bank accounts that aggregate to over $10,000 US. They have subsequently never increased this amount to meet inflation growth. If you haven't provided these documents, they can lead towards large fines. All the while, no tax is ever owed on these declarations to the Treasury Department. Until Fatca, Nixon and all subsequent presidents had no means to police the foreign banks and to enforce the rules.
For the sake of pinning the blame for the frustrations behind being an American expat, we blame Abraham Lincoln.
Lincoln may have abolished slavery in the United States, but made any American that moved out of the country de facto slaves, of which no other country other than Eritrea follows the logic, and even Canada has banned them from being able to do so. Abraham Lincoln introduced citizens-based taxation with the first income tax signed on August 5th, 1861, and was a measly 3% of income to help fund the North in the Civil War efforts. All of the above culminated in what is now known as the Fatca Accords established by Barack Obama. This law was designed to increase the compliance of U.S. taxpayers that had reporting requirements for financial accounts that were held in foreign jurisdictions. To ensure compliance throughout the chain, the new framework imposed legislation onto both the individual and the financial institutions that service the U.S. persons. This led to the stricter reporting standards and larger penalties being imposed for noncompliance. With the newfound power in place, the Fatca Accords essentially became the international policing force for U.S. persons with foreign accounts and assets. With over 113 countries having signed up to comply with the U.S. Fatca rules, and an additional 200,000 plus institutions having registered with the IRS. Don't worry, we're not going to just put a video for the entire day. We wanted to give you a little bit of a background of the history of what all of that is. You'll hear a lot of negativity surrounding Fatca, but like we said in the video, Fatca is really just the means for them to enforce things. And so I don't want you to be too nervous about Fatca. Fatca is just literally a placeholder there. What we really want to be concentrated on is a few things. Now, our FBAR reports are really important. Doesn't matter if you're opening up a foreign bank account, investment account, anything out of the United States. It is so important to make sure you do your annual FBAR filing. If you don't, the penalties can be severe. And the good news is by doing your FBAR filing, you're actually just disclosing that you have a foreign bank account. There's no actual tax. It goes to the Treasury. So anytime in aggregate it goes over $10,000, you need to make this reporting. Now, one of the functions that you want to be aware of with these FBAR accounts is that it doesn't just pertain to your personal accounts. So let's just say you are the president or a board member or the treasurer of a charity or another company that's got foreign accounts. Those need to be disclosed on there as well. So it's really important to understand those rules whenever you're a signer on any banking account or investment account in foreign jurisdictions. Now, PFIX to me is that one real takeaway, that if you never have to learn what it is, you're going to be much happier. Now, the concept is if you ever make investments that are invested outside of the United States, they will most likely be considered a PFIC. PFIC stands for Passive Foreign Investment Companies. And essentially, if you buy a mutual fund-like product that's in Europe or the UK, and that includes exchange-traded funds, the ones that are traded on the London Stock Exchange or on the Frankfurt Stock Exchange, those would all be considered PFICs. And the ramifications won't be obvious at the beginning. They become very obvious over the course of time as the taxes can compound in one of the two ways to do the reporting. So there are people that end up taking out their investments. They think they've done really well, but then the US government charges them more for doing so. Even more so with the stock market being down the last couple of weeks, what one of the benefits of investing in the US markets is that you're able to tax harvest. So if you buy something, if you sell it at a loss, you can use that loss to offset future gains. If we own PFICs, those foreign investments, we're not allowed that liberty on the US side of things. So all of a sudden, we end up having to pay all the taxes on the gains, but we don't get to take any of the losses against that. So we would always say, make sure to have your investment accounts back in the US. There are a few carriers that even we work with that are international accounts if you'd prefer to have it in euros or such, but you really want to make sure that anything you're using meets these specifications. The first reason that it's really easy to keep your accounts in the States is that it avoids all those PFICs. You don't have to worry about which exchange is this on, et cetera, et cetera. If we have our account on a US carrier, well, we're buying New York Stock Exchange listed ETFs, exchange traded funds, and the likes. We're buying individual stocks, and those are all conforming on that US side. Now, at the same time, you notice that I don't talk too much about mutual funds when I'm talking about that, and there's a reason why. Well, when we look at European law, essentially MiFID, which is the European law to do with securities, eliminates us from being able to purchase investments that are managed outside of Europe. So we get caught in this middle ground. So an active mutual fund managed from the United States is definitely not MiFID compliant. But we don't have to worry about that right now because there's no European standard of punishment for not conforming with MiFID. But Italy has a little de facto one that then they don't allow you to use the 27% rule, which is that European investments can be charged a tax of 27% instead of your regular tax rate. Outside investments could be taxed at your full tax rate. If you're a high income earner, that can be quite high. So you want to be careful with what your investments are. Just because something was appropriate when you were an American citizen or even a citizen of other countries might not be appropriate for you in Italy. So you might want to develop a strategy of how do you manage that. If you're only in Italy for a couple of years, it might be just make sure that it's something consistent that you're going to be able to hold throughout your entire stay in Italy. If you're going to be in Italy for a long period of time, it might mean that you want to ratchet and figure out a way to slowly exit that position. So the first reason makes our taxes easy because we don't compound new taxes by having additional PFIC aspects to it. The second one is the tax documents. A US-based account is going to give you a 1099. The 1099 just makes it so that your US taxes become very easy when it comes to your investments. So it will tell you exactly where to place each number. Now, in return, for our financial planning clients, we also help put together the European document, i.e. aligning the US dollar version into euros for the purchases and sales and the dividends, trying to make it as easy as possible to set up your European or your Italian taxes. That is helpful because most of your tax accountants, Italian or US, probably charge you on an hourly basis. The easier you make their life, the less hopefully they're charging you. The third one is compliance. If we have an American-based account, remember how I was talking about the FBAR and how there's severe penalties if you don't disclose those accounts? A US-based account doesn't need to be disclosed on the FBAR because it's already US-based. We don't need to worry about that. The fourth reason, safety. Well, America is built on a foundation of failure. The more it fails, the more it learns. And essentially, Joseph Kennedy, John F. Kennedy's father, set up the first SEC, the Security and Exchange Commission. And with that, we get SIPC and all these other protections. And all of our accounts over there are segregated. So if we remember back in 2008, when Bear Stearns and Lehman Brothers both failed, well, anybody that had their accounts at Lehman Brothers Their investments just moved over to Barclays Wealth Management, Bear Stearns over to JP Morgan. So nobody lost any money from investments or from those securities firms disappearing, because there was a mechanism for other institutions to take over and manage those accounts. A grievance and annoyance, yes, but it's not disappearing. Other countries, it's safeguarded. Most European countries are safeguarded by other means, which needs government intervention. So it's not to say that the money is going to disappear, but it's not so clear cut as when an institution fails in the United States. So we like those safety guards. And we had some of those Mediterranean islands years ago where essentially they took a 10% cut of all the accounts to try to bail out the government. So we get clearer precedent in the United States on that safety. We're not investing in some small island. The fifth one is the important one, fees. Fees, fees, fees. I told you we work with an international custodian, and they're wonderful, but they charge trading fees, they charge custody fees, and essentially that ends up becoming much more expensive. It can be beneficial if we're needing to invest in euros in the shorter term and we're needing to get it in and get it out. But when we're investing in the US in dollars, most of the platforms don't charge any custody fees. And the ones that do charge a trading fee, it's a fraction of what it is in Europe. So just like most other things, it's cheaper to do it in the United States. And therefore, those fees can actually compound over the course of time and add up to be a significant amount of money. So whenever you can, we keep our investment accounts in the US instead of investing them in Italy with one of the local carriers. The one place that might not be true is when it comes to pensions. We can't do an Italian pension in the United States. Italian pensions stay in Italy. US IRAs and 401ks definitely have to stay in the United States with those provisions. And there can be strategies around those. And if you guys have questions about those, we'll dig through those right at the end. That brings about one of our biggest problems. The United States, well, the US is dollar-based, and naturally Europe is euro-based, Italy's euro-based. And sometimes those exposures come to our major benefit, but sometimes to our detriment. So let's say you're worried about the dollar versus the euro for a short period of time. You might use the first four strategies: future contracts, forward contracts, options, and swaps. These are great ways if you're going to make a big purchase. If you're going to buy a house in Italy and all your money's in dollars, you might want to go ahead and secure a certain portion of that purchase price well in advance so that you don't have to deal with the swing. But if we're talking about your retirement, if we're talking about your investment accounts, and we're talking about a long period of time, 30, 40, 50 years, all of a sudden that can be very, very costly and get in the way of making good long-term returns. So what would we look at? We would look at natural hedges. Now, before I explain exactly what a natural hedge is, I'll kind of give a little bit of a tongue-in-cheek way of how to look at currencies. Now, the official economic vantage point is called PPI, the Purchasing Power Index, which is essentially how much can I get for each currency in different countries. Now, the economists back in the 1970s, they came up with a fun way to try to predict what PPI would look like, and it's called the Big Mac Index. Essentially, they took a Big Mac in all the different countries that offered them. Some countries down in Africa don't have McDonald's, so they actually call it the KFC index down there. You can't make those types of things up, but it's not the Pizza Hut index in Italy. It is actually the Big Mac index in Italy. So sorry, the humor is not going to be good here until Josh comes back online and actually makes some decent jokes. So I apologize for that. The Big Mac index basically tells us, well, is it more expensive to buy a Big Mac in a country or less expensive? So anything below that red line essentially are cheap currencies compared to the dollar. You see Switzerland, Norway, and Sweden are the only 3 countries that are more expensive for a Big Mac than the United States. And it's the same thing when we look at PPI. This is just an earlier predictor. Now, essentially, that means that we've had a long period of dollar strength. And, well, essentially, those poorer currencies will most likely come back up over the course of time, because historically, that's what we've normally seen. Now, just going back the last decade or so, essentially, we didn't have that many countries with a strong PPI after the financial crisis. People do what's called a flight to safety. People want the safe currencies when they're viewing global problems. So they flocked to 7 currencies that they viewed as strong and safe: Australia, Canada, US, UK, Switzerland, Sweden, and Norway. Now, what ended up happening was we had a commodity shock. Right now it's going the opposite way, but commodities dropped significantly in 2014. So Australia and Canada dropped off the list because, well, they're commodity-based economies. They're driven by what commodity prices do. So you had less places to invest in. Then we had Brexit, and naturally that meant that the pound was no longer a safe haven. So now we ended up with 4 strong currencies. And naturally, Sweden, Norway, and Switzerland are not able to absorb as much of this flight to safety as the United States is. That's why we're, I think, 14 years into a strong dollar position. And if we go all the way back into history, which we've got plenty of videos on, essentially, you'll always see that we normally have 10 to 15 years of dollar strength where people are flocking into dollars, and then 10 to 15 years where global currencies end up outperforming the dollar. So it's not really as much dollar weakness as it is global strength. And that's to where we're 14 years into everybody flocking to the dollar for safety. And right now, global stocks are much cheaper than US stocks. You keep hearing, if you look at the newspaper, US stocks are overpriced. Now, they're more expensive than their normal average, but you get great big conglomerates like Apple and Amazon and Google. But essentially, European stocks are cheap. Emerging markets are cheap. Most anything else is cheap. So once things normalize, we would expect those global currencies to go up, and therefore money coming out of the US dollar. So in the shorter term, well, we might have a little bit more strength in the dollar as interest rates are higher. In the next couple of years, as interest rates start to meander and increase in Europe and the UK and such, we would expect those currencies to go up. So how do we want to manage a long-term retirement? Well, we want to do that natural hedging. And this is why we don't just have your typical mix of conservative, moderate growth and aggressive growth portfolios that most managers have, or what your US managers would have. That's completely appropriate if you're retiring back in the States and you look at a Betterment portfolio or Wells Fargo or Merrill Lynch. They'll have their group of 5 to 7 different portfolios, but they're mostly naturally hedged to the US dollar. So that is what our mix in the USD line of portfolios is. It's a heavier proportion of US dollars, and you see the burgundy in that middle graph with that bigger allocation to the US dollar. But you'll notice in our Euro portfolios and in our GBP portfolios, we have a much bigger proportion in those currencies. So while 14% of the world's market cap is euro-based, we end up investing 11% more in euros. If you're gonna retire there in Italy, if you're gonna be there long-term, we wanna have those euros, because essentially we don't mind if a currency devalues if we're buying our bread in that currency, i.e. those 10 to 15 where the years where the euro is going down, it doesn't affect us so much. But if all of our money was in US dollars and the US dollar goes down for 10 to 15 years, essentially what we could end up having is a position where we're underinvested and we don't have enough money for our retirement at the time that you need to retire. We're going through that. So that's what natural hedging is doing. It's what every institution in America does. Typically, well, if you look at the MSCI Global Index, it makes up about 57% of the is made up by U.S. companies. But most every asset manager in the United States will have 80 to 90% in U.S. equities. Again, that's overinvestment is because most all their clients are Americans that are retiring in America. We're different. We're expats. We live over here and we might be retiring over here. So that's why we're looking at things differently and doing something more like the Italian banks would be doing, but we're doing it in the US. So I'm going to jump in here, Josh. If you want to jump in and why don't we take Laura's question really quick?
Yeah, absolutely. By the way, my camera, it can't. I need to be the host to turn it back on, so that's why it's not on. I didn't go anywhere. I promise. I'm not getting coffee in my pajamas. Yeah. So Laura says she is a retiree preparing for next year when she may be exposed to Italian taxes. So I guess her question is in regards to managing Roth withdrawals and the possibility of remaining as a fiscal resident of the U.S. And any tips we can discuss?
Oh, that's a great question. So essentially, it becomes a little bit controversial there from a vantage point of where that should be taxed. From the vantage point that I believe, and we had a tax session like Josh was referencing before, and I'll have to see if we did talk about Roth withdrawals, but Roths are not discussed inside of the double taxation agreement. So now, if you are essentially getting that, you want to get your interpretation from the local Italian accountant of how they're going to deem it. In other words, should it be deemed just like the income or something else? Because if it's like the income, then it should be taxed in the country that was made, which would be the United States, and therefore the Roth would be tax-free. If it's deemed as just a pension by your local accountant, then essentially it should be taxed in Italy. I've seen accountants do it both ways. Not being an accountant, I don't want to sit there and say which way is right or which way is wrong. What I'm saying is I can understand each argument based on the double taxation agreement.
And I guess there's always a chance that in the next however many years, they'll eventually get around to revising it to include such investment vehicles, though I don't know the probability of that.
Yeah, most of these double taxation agreements were written in the 70s and 80s. So we're 40, 50 years deep. And well, the ones in the UK and Canada are pretty good, but they're not in a hurry to rewrite too many of these. So I don't know if we want to hold our breath.
Right. Regarding being a fiscal resident of the U.S., are there any particular advantages to being a resident of the U.S. or Italy in this regard?
Absolutely. First of all, the taxes are much lower while you're essentially with your investments, and if you have the Roth IRA. So essentially, you're getting much lower capital gains tax, etc. But at the same time, you're not getting the Italian lifestyle. So it's really that question of, does it fit your financial plan to be in Italy? If so, then it's worth basically trying to make sure that we make it conform with those parameters for those distributions. But that's an easy one that we can have some conversations and introduce you to the right people offline, and probably help you get over that obstacle of deciding whether you should be fiscally resident in the US or Italy.
Right. Another question from Harry. He says, it seems to me it's always more difficult to have a US bank account with a non-US address. What do you suggest for a European-based US expat?
That is a wonderful question, Harry, and thanks for asking that. Some banks don't want to have foreign clients, and essentially the big banks are amongst those. I'm not going to sit there and name through them, but what we do know is that there are certain banks that are built for expats. Now, essentially, the one that we've had a lot of our clients use, if one of their local bank accounts wanted them to move because they found out they moved to Italy, is the State Department Federal Credit Union. And you can only imagine the State Department Federal Credit Union is built for all of those State Department employees, all of the diplomats, et cetera, that are moving all across the world. And for any members, anybody that joins American Citizens Abroad, they will let you open an account with them. And I think the membership is only $60 or $70. Now, American Citizens Abroad, first of all, I've got to disclose that I'm part of the advisory board, so therefore I have to throw in this commercial. If you don't know American Citizens Abroad, basically they're an advocacy service that is chock full of good information. If you can't afford the membership, I would definitely recommend signing up for their newsletter. It's completely free, so that you can stay informed with what they're doing. There is also a lobbying arm, and this is where it gets very interesting. Mary Louise is our lobbyist in DC. Normally we use lobbyist, the term, as a negative connotation, but us as 9 million American expats, we're underrepresented by our congressmen and our senators because, well, we're divided up amongst 50 states. And so Mary Louise literally goes around to explain to them our issues, our problems, our interests, and tries to solve them. Right now, she is working hard on residency-based taxation. But in the past, in the 1970s, she had to help. It wasn't her, she's not that old. She's the organization had to help us American citizens, and at that time, military personnel, get the right to vote as Americans abroad. So the only reason that we can vote is because of organizations like ACA being one of the important ones. Going through to then initiatives like the State Department Federal Credit Union for those of us that can't do so. Some of the tax organizations have a relationship with the Navy Federal Credit Union. And so if you use some of the big expat tax carriers, they'll get you an introduction with them. Myself personally, I've used some of the fintech providers. It doesn't work on utility bills and such, but it's great and helpful when you're going from the UK to Europe to different currencies, Switzerland, Sweden, and the likes, to use a Revolut or a TransferWise or a Sterling Bank. They all have their pros, that it's dirt cheap to exchange currencies and they're made easy. But if you have a problem, their customer service is horrendous. Since we're just down the street from them and I have several friends over there, I'll probably get an email or two, a little bit of hate mail. I'll definitely know how to get free beer for saying that. But they're worth checking out, especially if you're transferring money from the States over to Italy, because it makes it a lot cheaper.
All right, brilliant. Let's see. What other questions do we have?
You still see my screen, Josh?
I can still see you. Oh, I can't see your screen, but I can see you.
Okay. Well, go ahead and make me the host again, and then we can go through.
I believe you should be the host now.
Oh, perfect. Okay, I just have to hit the share screen again, don't I?
Yep. That'll help. Although if you want to share a video, you have to do the audio too.
Okay. So essentially, this is one of our new offerings that it isn't fully live, but essentially it's an alpha version. So we are a financial planning company in Dunhill Financial. So if you go to dunhillfinancial.com, you can find all kinds of information about us. Josh is our man on the ground there in Italy, and he helps build full financial plans for you to provide cash flow analysis and the likes. But sometimes you're not in that position that you need a full financial plan. You might be a younger person that's just trying to put away a couple $100 a month. You might be, in your 40s and you just have a lump sum from old retirement plans that you need invested, and you've already built your personal financial plan and you don't need assistance for that. So we've built a new system for those individuals so that they can get access to those, and it's called DF Direct. So it's a different website, df-direct.com. Now, essentially, you get the full US compliant investments. So you get access to all of those US investments that avoid the PFIX, that you receive the 1099s that are fully US compliant. It's essentially 0.5% per year management fee. So it's cheaper than doing the full financial plan, and there's no minimums. So you can start out with any balance and send in any monthly amount to get that full experience. Now, essentially, anytime you want to be upgraded to financial planning, you can at no cost, or anytime that you want to be moved back into the full robo solution, you can as well. So it's a nice robo offering, but if your situation changes, you move someplace else. For instance, you move to Austria or to the UK, there's different securities that you can own, and we want to make sure that we do the planning differently. So that is one of our offering. Now, I said we're an alpha launch. Alpha launch, what that means is right now we're only taking clients that have a US address that they can connect to that. That is the digital version. If you don't have a US address, well, you'll just drop us an email in there, and then we'll manually set you up to get started on DF Direct, but it's still the same pricing and the same low minimums. So a nice offering for everyone. This is a newer plan, and to our knowledge, it's the only one out there.
All right. Brilliant. Yeah, thank you for that, Brian. If anyone has any last questions, just feel free to put those into the chat whenever you like. I guess I had a question regarding the portfolios, just to clarify. We talked a bit about natural hedging, and I don't know if we also talked about the fact that goals can change over time, right? So how does that work if, say, somebody wanted to go from, so they're living in like Italy and maybe they wanted to go to the UK or something like that? Is that something that is a part of this strategy? How would that look?
Absolutely, and even more so. If you start out and you're more aggressive, and then as you get closer to your goal, you might want to be less aggressive. So all of a sudden, we might want to change from a growth portfolio down to a moderate portfolio. We should establish our goals and the reason why we're investing, and then set those parameters. So like you said, if you might want to move into the UK, so we might go from the Euro models to the UK models. Mm-hmm. Now, the UK models are more important because essentially we have higher tax if you don't have UK eligible securities inside of there. So we make sure that our GBP models are fully compliant in those ways. But those are those conversations that you have, and you tell us, okay, well, my goals have changed, therefore my portfolio should change.
Yeah.
We have a full risk assessment system, and I think this is a pretty cool system, that it doesn't just analyze somebody's risk. And you can go on our website, you don't have to be a client to be able to go through this, but you can go through and you can answer the different questions. Now you'll have the typical questions of, well, how much are you willing to lose in good years or bad years? We know the market's up 7 out of every 10 years, and this year happens to be one of those 3 out of 10 years where the markets are down. But over the course of time, it ends up doing quite well. Now, essentially, what our risk assessment does beyond that is it asks you if there's certain themes that are important to you, whether it be the environment, whether it be certain technologies, whether it be certain sciences that you're passionate about and you might want to see inside of the portfolio. And this makes it so that we can engage in the bigger conversation of where things might need to be inside of your portfolios. And so the portfolio should change in those ways over the course of time.
Absolutely. I think in the UK is a bit different in that aspect because I believe, like you mentioned, the UK, the investments have to be UK compliant. But I don't know if that is when you're living there or it's only if you plan to make withdrawals, like if you have a pension and you're not sure if you're going to remain in the UK. I'm not sure if it's so important then, but I guess it depends when you want to be taking the money out.
Yeah, not getting into too deep of
Right.
switching countries to the UK.
Yeah, that's true.
It's only important when you sell them. So if you move here for a couple of years and you don't sell anything, just like I was saying, if you have a whole bunch of mutual funds that are definitely not MiFID compliant and you live in Italy, if you can hold them the 2-3 years that you might be in Italy and not sell them, then it doesn't matter because there's no real penalty for holding them according to MiFID rules. It's all of a sudden, if you sell a mutual fund that's not MiFID compliant, then the Italians are going to say that goes in as earned income. That's the tax that you're going to owe instead of the 27%. And that could be quite painful because you guys have a pretty hefty tax.
We do have a question here from Gregory. Is there any tax downfall to acquiring dual US-Italian citizenship before relocating to Italy? Will this affect my public pension when I become a tax resident in Italy?
Well, it really depends. There's a lot of layers to that question. Essentially, if all of a sudden you're still a higher earner and you have periphery pieces in there, you should have enough credits from Italy to go ahead and offset any tax in the United States. That's what we would normally see. But naturally, we want to analyze that. So essentially, when you do your US taxes, you're going to have two options when it's earned income. So during your working years, you can either take the foreign earned income exclusion or you can take the credit system. Well, in your working years, that credit system in Europe is really attractive because the tax rates are higher in Europe than they are in the United States. The nice thing is during those working years, you can actually carry forward up to 10 years of those credits. So let's just say, and I'm going to make up some fictitious numbers because, well, I just want to make it as easy as possible. Let's just say you make 100,000, you owe 50,000 of tax in Italy, and you would have only owed 40,000 in the United States. So each year you have 10,000 more of taxes that were paid in Italy than the United States. Totally fictitious rates because those are way too high. But essentially, each year you would have 10,000 of extra credits, and at the end of 10 years, you'd have 100,000 of compiled credits. Those 100,000 of compiled credits can now be used to offset any tax that might be owed on that Italian pension as it comes out. So these are big strategies that you want to build and revolve around any of those foreign pensions that don't have a wonderful double taxation treaty like the UK and Canada have with the United States.
Yeah. And I would mention that, so we're not tax specialists ourselves, so that's not something that we would do as a matter of our business. However, we do work with people in the tax space. We'd be happy to introduce you to if you had any particular questions about that. That being said, just from what I've heard, I guess it depends, like Brian mentioned earlier, about which accountants you talk to, right? There are certain aspects where if you are a US citizen only in Italy, and again, this really depends, but this is what I've heard from some particular accountants, that there are certain aspects of the Totalization Agreement that you could put to use, whereas if you were a dual citizen, the Italians would view you as Italian and boom, that's it. Of course, don't lean on our understanding on that. It probably really depends on who you talk to, but just to give you a bit of a flavor of what some people in that space have been saying. Okay, George and Barbara Wilson, hello. Nice to hear from you.
I want to double down on what you just said on the Totalization Agreement. This is a nice, interesting concept, because the Totalization Agreement, there's always 3 double taxation treaties that you want to look for. You have the regular double taxation agreement, which is on earned income, pensions, et cetera, et cetera. You have an estate tax double taxation agreement for certain places. Now, this is not so important in Italy because what's the state tax? 4%? It's quite de minimis
Yeah, right.
in Italy. And the United States, you have a $12.06 million exemption. So therefore, a state tax is not the first thing that you really have to worry about in Italy, but it's significantly different if you just flip right across the border up into France. Same thing in Belgium, et cetera, et cetera. So not as important there. But then the third one's the totalization agreement. The totalization agreement is on Social Security. And Social Security, where it becomes important is, and this is your government Social Security, is that when two countries have a totalization agreement like Italy and the United States has, even if you didn't reach the proper amount of credits to get a full pension in that country, you can be eligible. So for instance, in the United States, you need 40 credits to be eligible for US Social Security. Well, typically you max out at 4 credits per year, and that's over 10 years. So if you work 10 years in the United States, you'll be entitled to a Social Security. Now, essentially, if you are not going to get 40 credits, but you work in a country that has a totalization agreement, you can go back to the Social Security Administration and say, hey, I worked in Italy. I only have 20 credits. Can I have my Social Security? You have to remember to apply for it because the US Social Security Administration is not going to know that, but you'll get a proportional Social Security from the United States for that amount. They will pay it into your Italian bank and they will pay it in euros, and it will be a better rate than Revolut or TransferWise or any of those because, well, naturally they get to go on the Federal Reserve System, so there's no charge for them to do it and there's no wire fee. So definitely something to be aware of when you're doing that.
Random side note, but you mentioned briefly the whole estate taxes, and yeah, it's not just 4% in Italy. It's also, that's after €1 million per head for close relatives, I believe. So it's pretty friendly when you compare to a country like France in that regard.
Absolutely, absolutely.
Yeah, so George and Barbara Wilson want to ask the same question Gregory did, but as a retiree. Presumably this would be more regarding the pension aspect, which I believe Italy would tax regardless of whether or not it's an IRA in the US.
Absolutely, and these go into really personalized, essentially plans based on all the different aspects of where the funds are coming from. So George and Barbara, what we'll do is we'll reach out separately so that we don't have to ask you the additional questions in a public setting, and we'll go through and itemize that with the two of you.
Okay, so Gregory, yes, I don't believe Italy will tax the public. The public pension could be different. This is more about the private IRAs and such. Yeah, this is also something that we also covered in our previous video. But all right.
Josh, will you send a copy of that? We'll send in the follow-up email. We'll send a copy of the full tax segment to everyone, because I know our time is coming short, and we don't want to we don't want to sit there and double dip on that.
Right. Yeah, absolutely. Okay. Yeah. So we will be sending a follow-up email with this information, including our contact info if you don't have it already. But unless anyone has any other questions, we would just say, so once again, thank you very much for attending the webinar. Feel free to get in touch with us with any specific questions you have. And yeah, we just hope you have a great rest of your day. We'll make sure you get a link to the recording of the video so you can review the material if you like later. And yeah, just always feel free to reach out if you'd like to get in touch.
Brilliant. Thanks so much for hosting. Thanks everybody for joining, and we look forward to hearing from you soon.
All right. So bye-bye, everybody.
Cheers.
See you.